important story coming in from our colleague at CNBC, Lakshman, telling us that there could be a hike as far as B-heavy molasses prices are concerned. But moving on, Sahil Kapoor, market strategist at DSP Mutual Fund, joins now to discuss market fundamentals and his top sectoral picks. Thank you so much for joining us, Sahil. First up, you've come out with a very interesting report where you've actually said that equity returns have, apart from a few countries, have actually lagged even US bond market returns. So first up, going into 2025, given the kind of outperformance that we've seen in equity markets over the last couple of years, how are you positioning yourself and what is your view as far as equities are concerned?
So if it is about 2025, I think it's very hard to say how the year will go. The only data that we have, or at least we had just a few months ago, was that equities were not priced cheap. When you look at equities as a whole, when you look at Indian equities, if you take, let's say, NSE 500 as a basket, it was trading at about 28 times trailing earnings, price to book of more than 3.7 times. These are not cheap numbers. Earnings growth, which was by the end of March 24, averaging about 22% CAGR over the last 4 years, is now on a YOY basis struggling at about 7-8%. So when you look at the aggregate ROE number, it's about 15%. So anything which has an ROE of 15% but grows at 7-8% is going to be very hard to justify a multiple of 28 times. So I think from a, let's say, next few quarters perspective, it makes sense to be conservative, maybe 25, 26. Unless you see cheaper equity prices, it's very important to look for value, look for margin of safety, and possibly exercise conservatism.
Sahil, I was quite interested to read about the 7 market myths that you've debunked in one of your reports, which goes on to say that if GDP rises, which means if India's economy is growing, we're going to get to Viksit Bharat, then there is no other way but for the markets to move up, and many others. So take us through the 7 myths and what is the reality?
So maybe we'll pinpoint a few which are very important. Yeah. First is that I think there is a lot of narrative fallacy and a thought that if GDP is going to go from X to Y, market cap should replicate that. And just to put 2 facts into these numbers, first is that when you look around globally, you will find that in most instances, it's not the case. There are countries where GDP has multiplied by a factor of 10, but equity markets have delivered returns which are negative. Case in point is our neighborhood, China. And there are many other. I mean, you could take a look at, let's say, Malaysia, Indonesia, for that matter, look at many European countries, you'll find very similar numbers play out. The only thing is that when you go back in time and look at data, you look at the US market and you look at the Indian market. Both of these markets have performed fabulously well. What it does is it creates what I call the problem of induction. You look at the last 25, 30 years for India, you look at the last 150 years for US, and you end up thinking that equity markets will always give you fabulous returns, which is true for these 2 countries. But unfortunately, it's not the case in many other countries. And therefore, if data falsifies that even if there is one country where GDP growth has not translated to equity returns, I think it is enough to burst this myth that GDP is equal to equity returns or GDP growth. Second thing is that, then what is more important, and which I published the second myth, that what is more important in terms of equity returns, or you could say, why has India outperformed if it is not about GDP or policy making, etc. So one very important factor is what is the return for shareholders. And there comes a very important distinction. When you look at the US market, almost 39 to 40% of companies in US from S&P 500 have delivered ROEs of more than 20%. So this means that there is a large shareholder return being delivered to, shareholders in the United States. And the second country, which is India, 1/3 of companies in India have delivered a ROE of more than 20%. Now, this is a great outcome, and we think that this is one of the most important reasons why India has delivered for a very long period of time. And I would choose managerial and entrepreneurial sagacity, their ability to navigate cycles over any other narrative of, let's say, GDP growth or any other number. So the crux of the matter is that managers and promoters in India have been able to deliver shareholder returns. And that is the reason why India has outperformed for a very long period of time, not only because there is a growing construct. And for that matter, we've shown in data that a country like Brazil, where the last 30-year GDP CAGR is only 2.5%, has actually delivered one of the highest dollar returns globally. So this is again a very, very important parameter to look at when you think about long-term equity performance. It's not only about how GDP is going to pan out. Another myth that in the overall scheme of things we've highlighted is a lot of people believe that very simple investing structures like a systematic investment plan or a dollar cost averaging is only for the retail investor. And it is not something that a sophisticated investor should exercise. And we've shown that even in countries like Japan, where 30-year returns are more or less negative, inflation-adjusted returns are negative, a simple SIP or a dollar cost averaging strategy also delivers 5 to 6% CAGR dollar returns, which are fabulous. You will not get these kind of returns very easily. So once again, there is a myth in the market that simplicity is too simple. So we believe that simple structures are much better than creating any complex structures over time. So these are some of the myths that we've spoken about in our report, and of course there are a number of other myths that we bust.
Right. Sahil, another very interesting point you've made is actually on gold being a poor investment. So that's another myth that you've written about. So talk to us about number one, gold. Number two, if you have a view on real estate, whether that should be looked as an investment vehicle. And you've also spoken quite in depth about quality businesses being stable. So these 3 points, if you could give your quick view on.
So gold is a very interesting case. I think in India, there is a big affinity for gold and people have done quite well over the longer term. One case in point I wanted to make, we've shown that in our report also. When you look at gold as an investment and look at all emerging markets, you will see that except in India, in every other single emerging market, gold has outperformed equities in the 21st century, which is the last 25 years. Even when you look at developed markets, in number of developed markets, I think almost all of them, gold has outperformed equity. Even in United States, in dollar terms, gold has outperformed equity. You could argue with the starting point and take a different position. If you take data from, let's say, another 30 years ago, you will find different numbers. But the case in point is gold outperforms equity in emerging markets. And the reason is that emerging markets go through a lot of accidents. There are political turmoils, there are wars, there is inflation, and all of these result in currency depreciation. And gold helps in countering that by a very wide margin. Even in India, just about 3 to 4 years ago, gold was ahead of equities over a longer term CAGR. So even in India, it's not a completely equity win. They lead and lag over a certain period of time. So that is one of the most important reasons to have gold in the mix in your portfolio. It provides possibly sort of a disaster hedge, which is very, very important for equity investors, specifically in emerging markets. And I think in the last 2 to 3 months, we saw some amount of this play out when currency depreciated. You saw that precious metal had a good time. Second point that you mentioned is about quality businesses. And I think there is a sort of a myth that if you buy a great business and hold it for a very long period of time, you are sorted. But the data also tells you that even great companies, which are fabulous businesses, can go through massive stock price correction. And we've showcased that in the report. A lot of great companies, which have compounded very well over a longer period of time, have fallen between 50 to 90%, even during their best times. So stock prices are slaves to sentiment, and businesses can continue to do well. Eventually, investors will do well, but you should have the stomach to digest that volatility.
Right. Thank